Into this webinar, Secure Your Financial Future, presented by James Blair. My name is Kirsty Muckle, the Engagement Manager for the branches at Engineering New Zealand, and I'm also the lead for our Wellbeing Programme. Before I hand over to James, I just had a few things just to update you on. So we will be recording this session and we'll send you a link to that recording in due course. Any questions can be asked via the chat panel throughout the presentation, and James will answer those time permitting. We do understand obviously the importance of wellbeing at Engineering New Zealand and want to ensure that our members have the tools and resources available. Since last year, we've grown our wellbeing offerings, and for all Engineering New Zealand members, not only can you access our website, but also the MAS Wellbeing portal. You should have also received our remuneration review email earlier on this week. And we would ask that all members just take the time to complete that survey, as there are questions in there relating to wellbeing and hardship. As we know, COVID-19 has affected everyone and also put some financial pressure on people, which has now become a bit of a reality. So we've teamed up with Lighthouse Wealth, which is an organisation passionate about making financial advice more accessible and empowering Kiwis to make their better financial decisions. Just before I pass over to James, just a bit more information about Lighthouse. They were established back in 2014 and have helped over 2,000 Kiwis make better financial decisions. They believe in making finances easy as a one-stop shop and have accountants, mortgage brokers and financial advisors. As I said, today our presenter is James, and he is a wealth director at Lighthouse. James has spent 10 years in the financial services, and prior to Lighthouse worked for a national team of financial advisors throughout New Zealand, where he achieved a lot of goals for people to help with their finance. James is passionate about helping improve financial literacy in New Zealand by making financial advice more accessible. This first webinar is sort of an overview, and in the future there will be, later on in October, more workshops dependent on where you are in your career. These are limited spaces and are interactive workshops, so I will put the links to those as we go throughout today's webinar. Again, thank you for joining and we hope you enjoy. Over to you.
Great, thanks for that, Kirsty. Thank you everybody for jumping on the call today, and hello to all of those who are watching on the recording as well. It's great to see so many people interested in making better or more informed financial decisions. We've spent, the better part of the year at home thinking about lots of things, maybe getting out for that extra run or getting our budget under control, buying our first house, starting to think about retirement. So these workshops are, I think, quite timely. As Kirsty pointed out, today is the first step in kind of 3 phases that we're going to run over the next month or so. So today is kind of our starting point. Everybody's at a different point in terms of their financial literacy, which is based off their experiences with money in the past. So I'm going to talk about 5 kind of key areas when it comes to money. But what I'd really like today is lots of questions. Kirsty will be sending those through throughout the presentation today. And if you want to, I talk about money all day, every day. So if you want to take us off course and we've got some questions, I want you to get the most out of today possible. Off the back of today, there's going to be an opportunity to book in stage 2, which is based on your stage of life. So those 3 stages will be buying your first home or saving for your first home if you're in the middle of your career. So it might be around paying down debt and generating wealth, and those within 10 years of retirement, which is, what does retirement look like? How do I invest my money? And then the 3rd stage is to have a free one-on-one session with a financial advisor to get all your cards out on the table and plan out your future. Kirsty said a little bit about Lighthouse, so I won't touch on that. We'll get to the good stuff. But very quickly, Lighthouse do kind of 3 main things. What we focus on is, first, helping people come up with a plan. And if you take away one key part from today, having a plan of where you want to go with your money is really important. And why that's really important is you get up every morning, you go to work, you kind of in the trenches. What are you working towards? What are the goals and your objectives you're trying to achieve? Once you know where you're going, we then focus on growing your wealth. So that might be helping you plan for retirement. It might be helping you buy a rental property. It might be around Kiwisaver advice. Nobody likes to really talk about the downsides of life and when bad things can happen, but as well as growing your wealth, we help Kiwis protect their wealth. So that's about having the right structure in place for your assets. It's having insurance. It's making sure you've got up-to-date wills. It's thinking about all the things that nobody thinks is going to happen to them, really. And by doing those three things, we help you get ahead in life. Now, very quickly, before I get into the content today, important to touch on, so I'm an authorized financial advisor. Today is not personalized advice. I'm talking in general terms. Everybody's situation is different, which means the actions and the advice you should take will be different. The really good thing is you're going to get the opportunity to have personalized advice, so I'd strongly suggest you take up that opportunity. That's enough about disclaimers, though. Okay, so I know we've got a lot of engineers on the line at the moment, and for those watching the recording as well. So I thought, I've looked after quite a few engineers as clients before. I know you guys love your spreadsheets, you've got your numbers all sorted. So I thought we'd start with 5 really good stats to get you thinking. Before we talk through those stats, as I said, one of the things I'm really keen to do today, though, is to have lots of interactions between you and myself and make sure that I'm not just looking at myself on the camera and talking. So we've got some questions that we're going to ask throughout the day, so some polling, to get me a feel about what you're thinking and where you're all at. Obviously, it's all anonymous. So, Kirsty, if you can bring up the first question for everybody to answer, and this is just it's completely anonymous, just to give me a feel. How do you rate your relationship with money at the moment? So 1 is you need some help. 5 is you're killing it. You just don't know why you're on the webinar. You could probably run it. Awesome. Look at these numbers. Okay, so we've got mainly 2s, 3s, and 4s is pretty common. Well done to those 4 people who are doing an awesome job. So what that tells me today is some of you are making some good decisions, but you're thinking about what you could potentially do better. Perfect, that's why we're here today. The first of the stats is 46%, and that's 46% of Kiwis are worried about their money. That stat was taken at the start of the year through a survey, so I'm guessing it'll probably be even higher at the moment. But that means 46%, about half of you on this call are worried about money in some shape or form. That might be buying your first home, how are you going to get on the property ladder, going paycheck to paycheck, you might have some credit card debt, you're worried about retirement. It can be a lot of different things, but this is why we run these workshops and why I've teamed up with Engineering New Zealand, is to help get that number down and give people more access to financial advice and feel more confident about their decisions. 10%, for those first home buyers out there or hopeful first home buyers, 10% is the minimum deposit in most scenarios that you need to buy your first home. So if you're going to buy a $700,000 house, you'll need $70,000 as a deposit. If you're buying a $300,000 house in Invercargill, that'd be $30,000. As well as a deposit, you need to be able to service a loan. So 6.5 times is the general rule of thumb. So 6.5 times your earnings, your salary, is what you might be able to borrow. So if you earn $100,000 a year, you might be able to borrow $650,000 as a loan. I spoke before around how important it is to protect the downside risk of your situation. So you're focused on, I guess you've got a plan in place if the worst were to happen. Only 20% of Kiwis have income protection insurance. Only 20% are insuring their income. That's a big problem, because if your income stops coming through, how are you going to continue to pay your bills and pay your mortgage and look after your family? And the very last stat is 80%. So I think you need about 80% of your after-tax income in retirement. So if you're earning $2,000 after tax a fortnight, I think you need about $1,600 in the hand to live a comfortable retirement. You can do a no-frills retirement, but hopefully for all of you, you're going to live a really happy, comfortable retirement. So we're going to talk about Kiwisaver and how that can help you. So in terms of the topics we're going to cover today, here are the 5 subjects that I've got planned to run through, which is buying a house, budgeting, debt, Kiwisaver, and insurance. We've got another polling question for you. As I talk about money all day, every day, I'm having to change this on the fly. What are you most interested in hearing about today out of these topics? Which one's kind of front of mind for you? Maybe I'll spend a little bit more time on it. Got a lot of people keen to buy a house, budgeting, debt. No surprise with the insurance, based on those stats before. And a bit in Kiwisaver as well. Okay, that's good. That means that we'll probably spend a pretty even amount of time on all of those topics. And as I said, I really encourage you as I talk through these topics to ask lots of questions as you go, and we'll pause during the webinar so you can ask any questions that you have. Firstly, buying a house, the Kiwi dream that is starting to feel a little bit more like a dream and less like a reality. COVID, you would have thought all logic would dictate house prices would go down, yet we're seeing in the Herald that there's 100 people at auctions, house prices are soaring. I believe there's kind of 2 key reasons why house prices continue to go up. One is the reverse brain drain, which is fascinating. Who would have ever thought we would have seen that happening, which is expats coming home who are ready to buy a house. And the second reason is interest rates, and the main reason, to be honest. Interest rates are at record lows, and a lot of people are thinking they're going to be low for quite a long time. So if you're looking at buying your first home, I think in 2020 we need to have an honest conversation about whether you should buy. In other parts of the world, people rent their whole lives and they do other things with their money. So let's look at some pros and some cons around buying versus renting. Firstly, some of the benefits of buying is you're securing your entry point into the market. So what does that mean? Is if you change your mind later on from renting to buying and the value of houses go up, which generally they go up about 5% every year, it's going to be harder for you to get onto the property ladder. So you're securing your entry point into the market. The second is you're paying your mortgage instead of paying someone else's mortgage. So I talk to lots of people who might be spending, I don't know, $30,000 a year in rent. And based on some really kind of high level assumptions, if they were to pay the same amount on rent as they do if they owned their house, they might be paying $10,000 off their mortgage every year, because you've got obviously the interest of the mortgage as well. So you're paying your mortgage, you're getting ahead instead of your landlord getting ahead. You're leveraging your deposit for greater returns. What that means is that there's not many assets where you can start with like $100,000 and borrow some money from the bank and own a $500,000 asset, and then you're making a capital gain on the larger amount. You've got peace of mind that you can't be evicted, your landlord can't sell the house, that you're getting inspections done. And this isn't a pro or a con, but about 26.5% of your take-home pay goes towards servicing a mortgage. When it comes to renting, you can potentially live in a nicer area than if you were able to buy. I'm sure a lot of people could relate to that. You could use your savings to invest in other assets. So you might invest into a business or invest into the stock market or a managed fund. That point above as well about not being tied down by such a long-term commitment. If you're planning to do an OE in the future with a 20, 30-year mortgage that you've got to service, it's going to be a lot harder to do those things. There's no penalty to move if you're renting apart from paying a bond and moving costs. And as you can see, it's about the same between paying a mortgage versus servicing rent. So there's kind of some pros and cons. Now, if you said to me, well, James, that's great, I really want to buy a house. Perfect. Let's talk about some frequent questions I get about how to that I get about buying your first home. The first one is, how much do I need to save? As I said before, the general rule of thumb is about 10%. So 10% of the purchase price. So as I said before, if you're going to buy a $700,000 house, you'd need $70,000. Now that can come in quite a few different ways. The traditional way is you save and then you buy a house. But now we've got Kiwisaver, which has been around for more than 10 years. If you have a partner, have been in Kiwisaver for a while, that might be a really big chunk of your deposit. Plus you might have some savings. You might be lucky enough to have a family member or a friend who wants to support you into buying that house as well. Do I have the income to support a mortgage? The only way to find out is to go and talk to a broker or go and talk to the bank. But as I said, a good general rule of thumb to get you thinking is you can borrow up to 6.5 times your income. So $100,000, $650,000. Do I need a 20% deposit? No, you don't. The benefit of having a 20% deposit is the bank will give you a better interest rate. So instead of, you might get a 3% interest rate hypothetically if you have a 10% deposit, but you might be able to get a 2.5% interest rate if you have a 20% deposit. So that's something to think about, but there's a lot of pros in terms of just using the 10% deposit opposed to waiting. Should I go to a bank or a broker is a question I get all the time. I worked for a bank for a long period of time, but I am in favor of using a broker. And the reason I'm in favor of using a broker is, firstly, the bank pays for the broker. You get a free service by dealing with the broker, and the broker will go across all of the banks to look for the right deal for you, which might be simple yes or no, whether you'll be able to buy a house or not, but also how much you can borrow, good interest rates, maybe getting some cash back. And banks' appetites do change, so it's good to go and look across all of the banks. Is now a good time to buy? That's probably question number one at the moment. If you were to buy a house now with COVID happening, a lot of people have been saying, well, a house price is going to be 5%, 10% lower in 6 months' time. My answer is always potentially, but you've got a risk here. The risk is they don't go down and they go up. And I think the risk of them going up is greater than the benefit you get from them going down. I'll say that again. I think the risk of them going up has a bigger impact to you than if they go down. And the reason I think that's important is if you buy a house, essentially 3 things can happen. 1 is the house goes up, 2, it stays the same, 3, the house goes down in value. If you buy and the house goes up, happy days. If it's flat, that's fine. If it goes down, you should be looking to buy a house for 10 years or more, right? You've got to have somewhere to live. So if that house drops in the short term and then kind of moves up over time, it shouldn't bother you if it drops 5 or 10% in the short term. But if you wait and that value of the house, goes up, a $700,000 house might cost you $750,000. So that's your real risk, in my opinion. And there's no right or wrong answer in terms of whether they will go up or whether they will go down. The reason it's just the risk associated is, I think there's a bigger impact to you is if you wait and then they move up. How much can I borrow? As I said, about 6.5 times your income is a good starting point, also depending on the size of your deposit. Can I live in the same area you rent at the moment? That's something you might have to sacrifice. A really good way to find out, though, is to use homes.co.nz or Trade Me Property Insight to have a quick look, a little sneaky peek at the value of your house at the moment. And if you kind of do the deposit and the times my earnings piece, you might get an idea of whether you could borrow or not. What else should I be thinking about when looking for a house? One thing, if you're going to buy at the moment, and we're going to go into a lot more detail in this in the next workshop, which is a bit of a plug for that, but a few things to think about is, firstly, if you're going to buy in a market that's quite chaotic, that means a lot of other buyers are going to be emotional. when people are emotional, it means you're probably going to lose a few auctions or lose a few houses before you win one. You need to educate yourself on the market to understand it before bidding, or you risk overpaying for a house. So go to lots of open homes, understand the market you're buying in, find out what houses have sold for in the past. We've got a few questions here, and then I'd encourage you to chuck in some more questions if you've got them around buying a house. I see Bell's asked a question here. Do banks require you to get a building inspection of the property you want to purchase before lending? It does depend on the property, Bell. The answer is no. A lot of people buy a house without a building report. My suggestion to you, though, is a house is one of the biggest assets you're ever going to buy. And if you buy a house without a building report and there's $100,000 worth of damage to the house that you didn't know about, you wish you would have spent the $300 or $400 on a building report. So usually, no, the bank doesn't require you to get a building report, but I'd really suggest that you do get one. Got another question about brokers don't use Kiwibank. Why is this? Well, actually, that's changing at the moment. Essentially, Kiwibank didn't have a broking department, but they're getting back into it now, so they should be able to use Kiwibank as well. What are the pros and cons for buying a new house versus an older house? That's a great question. And I can see a lot of questions starting to come through, which is awesome. So the benefit of buying a new house is it's off the plans, it's just had all its compliance done, it's unlikely you're going to have any issues to the house in the short term, right? There's not going to be any DIY required. So it's quite easy for you. The benefit of buying an older house is you might potentially get a little bit of a discount depending on what you buy, but you might also be able to add some value to the house. So if it needs a lick of paint, if it needs some new carpet, they're all things that will help appreciate the value of your house and get you some more equity in your home. So it depends what kind of person you are, whether you like spending your weekends doing a bit of DIY. Emily said, I know I don't want to buy as I might move country in a few years, but these questions are, here we go. But I am sacrificing an opportunity to make a higher return on my savings. Well, Emily, if you're planning on moving countries in a few years, I mean, it all obviously depends if you're going to come back and those sort of things. Potentially you are, if a house is the best returning asset. But the other thing to think about is sometimes property isn't the best returning asset. You might invest into the stock market. You could potentially invest into a business, which is kind of what the stock market is. You might invest into a managed fund. So there are other opportunities, but I think you've also got to be at the right stage of life to buy a house as well. Charlie said, if having say a $700,000 house with my parents, am I eligible for the $5,000 government money, seeing my investment is $300,000? No. So the question here is, there's something called a first home grant. I don't know if any of you have heard of a first home grant before, but essentially, if you earn less than a certain amount, which is $80,000 for an individual or $130,000 for a couple, and you buy under a certain threshold value house, you might be eligible to a subsidy, which can be up to $10,000 for a couple if you've both been contributing to Kiwisaver for 5 years. If you buy half a house, like if you're buying a house with somebody else, the question here is, am I eligible to the subsidy? No, you're not, because the value of the house is over the subsidy. We will talk about those subsidies in detail in the next lot of workshops, though. I'm loving all these questions. It's quite hard to pick between so many. We'll see. Yeah, another question is this a right thinking? House is a depreciating asset. Land is an appreciating asset. Really good question. The value in a lot of houses does come down to the land. That's where the majority of the value sits. You're going to have to upgrade the house as general wear and tear happens to the house. But there's also building inflation as well. So a house that was built 20 years ago is going to cost less than a house that was built today. Okay, I think we might leave some of those questions for now, and I'll keep moving. Otherwise, we're going to run out of time. But I love all the questions. This is great. Let's keep them coming, and I'll see how I go keeping up. So the question is, say you buy a house. What do you end up with? A lot of debt. I've got a house, I've got a lot of debt, gets me up early in the morning, keeps me on my toes. But there's different types of debt. There's good debt and there's bad debt. Now, what's good debt? Good debt is assets that kind of appreciate or generate future income for you. So an example of good debts might be buying a house because you don't have to pay rent and the value of the house will probably go up over time. Buying a rental property, buying into a business which will generate you future cash flow, or say you're in a trade and you're buying a ute so you can go and do jobs and earn money. They're examples of good debt. Bad debt is debt that is essentially sunk cash. It's not getting you ahead in life. So the two big ones which I see all the time is credit card debt. So we spend too much, we go over our budget, the credit card blows out, you might be on a 25% interest rate on your credit card, and it becomes really hard for it to pay it off. The other one I see all the time is car loans, so paying 8% so we can get the new flash car, which is a depreciating asset, right? You're not going forward. So I'd really focus on credit cards. Can be good, don't get me wrong, you get some points, but you've got to pay them off every month. But we really need to focus on good debts, get debts that get us forward in life, that help us achieve our goals, that help us grow our net worth, and stay away from bad debts which generally have really high interest rates. So say you've got a mortgage. One big thing with a mortgage is it's over such a long period of time. It can take 20, 30 years to pay off a mortgage, which means there's shiny, fun things in the interim which can distract us from paying off our mortgage. Some of those things might be a holiday, more daily spending than we plan, new cars, upgrading our home, renovations, or taking some time off work. Now, I'm actually fine with all of these except for one, which might surprise you as a financial advisor, but the reason I think it's really one of them really bothers me is this more daily spending than planned. And that's important because you're going past the budget, you're going past the strategy and what you've worked out that you can spend. Well, you might say to me, well, James, I'm only spending another $100 a week. I get my coffee in the morning, I buy my lunch every day. It's not that big of a deal, is it? Let me give you an example. So if you spend an extra $100 a week on an $800,000 mortgage, so this is a scenario, and you have a 4% interest rate, and your fortnightly repayments are $2,000 a month. The difference between paying $2,000 a fortnight and $2,200 a fortnight, I'm keen to see how much interest you think you will save over the term of the loan. So Kirsty, if you could bring up the next polling question, in this scenario with the three bubbles, how much do you think you will save in interest over the term of your loan? $50,000 is pretty popular. I feel like a horse racer. $70,000 coming back, or an auctioneer. A couple of people have said not a lot. Okay, so most people are thinking it's quite a lot of money. Thank you for that, Kirsty. You're actually right. It is a lot of money. So if you can save another $100 a week, or put $100 towards your mortgage a week, you will save $70,000 in interest, and you will pay off your mortgage 3 years faster. So in that original scenario, $2,000 a fortnight repayments, you're still paying $440,000 in interest versus $370 in if you were to pay a little bit more. The interest on a mortgage kills you over time. It's, don't get me wrong, the value of your house is going to go up, going to be generally happy days, but you need to be aware of how much interest you're paying on your mortgage. I'll give a quick shout out to a tool, sorted.org.nz. If you go on the tool, look at your mortgage repayments, the interest rate, and your and how much you pay off your mortgage each fortnight, you'll be able to see how long it will take you to repay your mortgage and what the interest rates will be. Okay, so there's a little bit about debt, about having good debts versus bad debts, and also a little bit extra on our mortgage makes a big difference. Have we got any questions around debt? Okay, we've got one here. Am I better to pay off my remaining mortgage ASAP or invest the extra money elsewhere? Where is there a better return? So for that question, we go into that in a lot of depth in the next workshop. What I would say, to kind of give you a really high-level answer, is generally you're best to pay off your debt before you invest. The reason for that is if your interest rate's 3%, whatever return you make on another investment, it has to be after tax, after fees, but also after inflation, because you're not spending the money now when the value of everything goes up in the future. So that's actually quite difficult to do. Potentially the only exception is rental properties. And the reason rental properties might be a good exception is because you can deduct some of the costs associated with the investment. But we'll tackle that a lot in the next workshop. I've got another question. It's no surprise we've got questions about buying investment property. Kiwis love their property. What do you think about leveraging to buy an investment property? Once you've paid down some of the debt on your owner-occupied place, we've got this thing called lazy equity in our situation. So for example, you might own $1 million house and have $400,000 owing, which means you've got $600,000 of equity. An option is to leverage up and to buy a rental property for future capital gains, maybe unlikely, but potentially make a little bit of money each week from the rent. For quite a few people, I think that's a really good option. You need to hold the investment property for a long period of time. The other thing to think about, though, is Kiwis just love their property too much. And what that sometimes means is people will have all their money, all their eggs in one basket with Hamilton rental properties. It's important to get diversification. And I'm not talking about also getting Auckland rental properties. I'm talking about looking at different assets and different forms of income. So Kiwisaver, managed funds, investing in a business if you know what you're doing. We got a question about student loans. So am I better off paying off my student loan as slowly as possible, as my money will make more elsewhere because student loan's interest-free? Absolutely. Sometimes people like the idea of paying off their student loan as fast as they can. I know you get an extra 12% in the hand once the student loan is paid off, but you're never going to get another interest-free loan in your life. You might as well take the money that you could use to pay off the loan and invest it into, savings accounts don't earn anything. But if the money's for the long term, into a managed fund or into an investment, save towards a property, buy a property faster. Another question is, what's your favorite managed fund and or managed fund provider? Well, personally, it's my own solutions, which I build. I work with an independent research house and build investment portfolios based off a whole plethora of different funds available in the market. If you're thinking about just small regular drip feeds, there's lots of good ones out there. Milford are a really good provider. Mint are a good provider. A lot of the bank's products aren't bad. They're accessible, which is nice. But you just want to do your research. Go onto the Sorted website, look at the returns on managed funds after fees, and see which ones are doing really well. Kent has said, is a managed fund a portfolio of different investments that I don't have to manage directly, like compared to if I tried to invest in such things myself? Yeah, absolutely. So say Sharesies. A lot of people know Sharesies. Sharesies is you're investing directly. A managed fund is you go, hey, you guys are the expert. Here's $1,000 a fortnight or a month or whatever it might be. Go and get me a good return. Okay, so let's say you haven't bought your house yet. You don't have your deposit. Maybe you have a little bit of credit card debt and you really want to pay it off, or you've got a home loan and you want to repay your mortgage. Budgeting is your answer. If you are not a good budgeter, I'd strongly recommend you get better. It's one of those skills which, if you can nail it, you will get so much further in life from a financial perspective. So now I've got a quick question for you, another poll question. Do you feel confident with your budget? I'd love to know. Yes, no, maybe. I'm not perfect with my budget. I'm a financial advisor and, I could do better. I went and got some sushi at lunch today. I could have brought my lunch. I'm not very good at bringing my lunch from home. Okay, about 30% of you think you're very good. So that's great. And for the other 70%, maybe a little bit of help. So as I said, if this is a skill that you can really master, it's going to benefit you and help you achieve your financial goals so much faster. So let's look at some of the tips I give my clients to help them get ahead in life. So 3 tips I give my clients is, first, give every dollar you earn a job. So what does that mean? I mean, you need to be a conscious spender, not a mindless spender. That means that you have $2,000 hypothetically coming in a fortnight, and you should know where every dollar goes. You should know that you have to pay your rent, you have to pay your electricity bill, you're going to have some fun, you're going to buy those shoes you wanted, you're going to go out with the girls, but you're also going to save whatever it is that you're saving to achieve your goal by the time frame that you set, because as I said, having goals is really important. I'm all about balance. I'm all about having fun. It's pretty boring if you just save and you don't do anything enjoyable. But when you're having fun, you need to be conscious. You can't be mindless. And what that means is it's so easy to tap and go these days. You tap and go, you don't think about it. If by tapping and going and not keeping on control of your budget and where your money's going, and you don't give every dollar you earn a job, it kind of disappears pretty quickly. Now, for those of you who might say, James, I can't save at the moment, 1 out of 10 of you, I'd agree. I'd say, yep, your situation is tough at the moment. Just need to hold on and it'll get better. For the other 9, I'd say, yes, you can. And the reason why I say yes, you can is I like to use the example of, what if taxes went up tomorrow? Let's say they went up by 20% or 10% or 5%. What you'd do is you'd bitch, you'd moan, and then you'd pay your tax, and you'd find a way to live with whatever you've got left over. So why not tax yourself? Why not tax yourself 5, 10, 20% of your income, siphon it off to a different account you can't touch, and tax yourself to reward future you to achieve your goals faster. So give every dollar you earn a job. Be a conscious spender, not a mindless spender. And if you're not good with money, think about taxing yourself. The other concept I talk to my clients about, which is kind of similar, is around the 3 mason jars. So when I talk to my clients, their money comes in every fortnight. I talk about splitting it into 3 mason jars. So we've got our fixed expenses, we've got the fun we have, and then we've got our savings account as well. Only one of these jars is getting us ahead in life. And the jar that's helping us get ahead in life is the savings jar. Now, even with the 3 mason jars, people still fall over. I'm not sure if you can guess why, but I'll tell you. It's because they have fun. They pay their fixed bills, they pay their rent, they pay their electricity, they have fun, and then there's no money left for savings. What you need to do is go fixed, savings, and then fun. You need to work out how much you can save a fortnight, and whatever's left over in the fun account, which obviously, be impressive if you had 3 mason jars, but we're talking about 3 bank accounts here. Whatever's left over in the fun account, once it's gone, it's gone. You wait till the next fortnight. So be a conscious spender, not a mindless spender. Think about taxing yourself to pay future you if you're not good with money. Give every dollar you have a job, and think about implementing the 3 mason jars. We'll see if we've got any other questions about so we've got a question here from Isabel, which is how much percentage of your paycheck should you spend, save, invest? Great question, Isabel. Unfortunately, that's one of those ones where it's impossible for me to give an answer like that. It depends on some people don't have many fixed costs, others have lots. What I would think about is working through a budget and going line by line, or at least just really roughly. You'll know how much you're fixed, how much is your rent, how much are your bills, and then once you've paid those things, the rest can go between the savings and the fun account. It'll depend when you're at with your stage of life and how important having fun is to you, but you should be trying to siphon off, if you could save a couple $100 a pay, depending on where you're at, then that would be great. Warren's asked, how do we register for the workshops coming up? I think Kirsty's got something that she's put on the screen in the past, but you'll also get an email at the end of today. Is there any good budgeting tools out there to help? Great question. Firstly, I'm a good budgeting tool. I help lots of my clients almost just keep them accountable. Secondly to that, I think it's called, there's a really popular American one. It might be called like NYAB or something along those lines. If you Google budgeting tools, there's a 4-letter acronym kind of like that, which will pop up. The Sorted website is another really good one. We've got another question in here. How risky is it to throw everything in your deposit only to fall back on your credit card? I'm assuming that question is related to, it might be related to deposit as in a home deposit. If that's the case, you should always have an emergency fund. An emergency fund is really important, and what I tell people is a 3 to 6 months of expenses is a good size emergency fund. So no, don't just fall back on your credit card. That could get you in a sticky situation. Someone asked is, can we ask what your investment portfolio is like? We'll talk about that in a future workshop. Just the way investment portfolios work in general. Sorry, John, might be telling you how to suck eggs here if you do know a bit already. Investment portfolios are generally broken into 4 assets. So that's cash and bonds, which are low risk, property and shares, which are more high risk but will deliver greater returns. The split of those assets depends on how much risk you're comfortable with. Would you be able to send the presentation through email? I'm sure we can work something out. Alrighty, only 7% of you, when I asked you what you were interested in hearing about, was insurance. Well done to those 7%. I'll give a little bit of plug wider than just insurance. So as I said, growing your wealth is great, but things happen in life which are really sad. People get sick, people pass away, relationships don't work out. It's important that you've got good foundations to your financial planning. So that means having a will, it means having your assets in the right structure, and it also means having insurance. If you are single, you are reliant on your income to pay your bills. If you have kids, a dependent partner, and a mortgage, you need insurance even more because you've got other people dependent on you. It's just not you that you're skimping on. So we've got the next question here. When it comes to insurance, there's some insurances that are more popular than other. What do we think our biggest asset is? You guys are a smart bunch. Nobody's got like a Lamborghini parked in the garage. There's no $400,000 Lamborghinis. Okay, so most people think your income is your biggest asset, and that's 100% right. Unless you're really close to retirement, your income is your biggest asset. A really simple scenario is if you're 30 years old, if you earn $80,000 a year, that's $3.2 million off the back. Assuming you're going to work for 40 years until 70, might be a little bit depressing. But not many people have an asset greater than $3.2 million. If we think about those mason jars, your income is the ability to fill up that savings mason jar, which then allows you to generate future assets. You want to use your income to kind of generate assets that will give you a passive income in the future. But when it comes to income is your biggest asset. Yeah, 96% of people will insure their car, but only 20% of people will insure their income. It's crazy. It doesn't make any sense to me, except for the simple fact that people don't think it will happen to them. They'll think insuring their income, insuring their life is a waste of money. I can tell you, everybody that dies and everybody that gets sick, they don't expect it to happen to them. But that's why insurance is really important. So income protection is if you are off work for a period of time, and we know for a couple that's 30, there's a 25% chance that one of them gets cancer before retirement age. If you're off work for a period of time, then you insure your income to continue to get paid while you're off work. We know that if you're off work due to sickness, there's a 96% chance that you'll go back to work within 5 years, which is great. But 5 years for most people with no income, they're just stuffed. So think about insurance. Make sure you're being responsible and taking care of the people that you care about. A lot of people say to me, income protection is too expensive. Usually it's 1 or 2% of your take-home pay, which is, in my opinion, not that bad. But if it's too expensive, insure part of your income. You don't have to insure all of it. Insure something so your family's going to be okay and looked after. Somebody said, my biggest asset is my health. Absolutely. Being healthy to be able to do things, one of them working, one of them earning money, is absolutely right. Another question, let's pop in some more questions if we've got around insurance. Another question is, how is this different from good savings / an emergency fund? So insurance, an emergency fund will last you 3 to 6 months. If you're saving for anything more than that, it's, in my opinion, wasted capital that you could be investing somewhere else. Income protection is if you're off work for, say, 2 years, which happens a lot more often than you think. And as I said, that kind of 25% chance for a couple, one of them to get cancer before 65. Income protection gets you past your emergency fund and means you continue to get paid. You've got life insurance if you were to pass away, allowing your spouse to pay down some of the debt on the mortgage so they can be comfortable. You don't want to have to be dealing with mourning for someone's death or being sick and then also being stressed about your finances. Somebody has asked me, how does a trust protect your assets? Is it a form of insurance? I wouldn't call it a form of insurance. It's about potentially having the right structure for your assets. I'm not a lawyer, so probably shouldn't be giving you advice around a trust, but a trust can be a good asset to protect property, so a certain income can trickle down to certain beneficiaries, or protect you if you are a director of a company or something like that. But getting advice is really important. John said medical insurance versus life insurance, or both. So medical insurance, I think, is important. You can get like GP and dental insurance. Personally, I think that is a little bit of a waste of money. What you want to insure is what we call the low probability of it happening, but the high impact. So an example of that would be you need to get a knee replacement that's going to cost you $50,000. So you want to insure those type of scenarios. When it comes to life insurance, so medical insurance is paying for surgeries, specialists. Life insurance is if you die, whoever you nominate will receive a lump sum, especially if you've got lots of, like a big mortgage, to help look after your family and pay down some of the debt if they're not going to have your income. Okay, I'm just looking at the time. We might answer one more of these questions. Another one said, I had no idea income insurance. Just checking. Can somebody pop in the comments section? They can hear me.
Yeah, Jane. Sorry, I'm not sure what happened. Not sure what happened there, but you're back.
That's all right. We're back. Somebody said to me, I'm a bit scared to click on the questions now, but I had no idea income protection was a thing. Can you advise on what to focus on and what questions to ask? So the good thing is, in the personal one-on-one sessions, I can help you work out what the right level of insurance is for you. It's probably a little bit tricky to tackle that one-on-one. Thanks to those who've said insurance, that the session's working. And the last one, if I was to be fired or I got laid off or quit, would insurance protect me? No, I don't personally like redundancy insurance. The reason for that is most people have a good set of skills and can find another job. I mean, I might be talking out of turn here, but I think being in the engineering industry at the moment, when the government's trying to stimulate the economy, it should be a pretty good industry to be in potentially. But what I'm trying to say is there's a bit more risk at the moment when it comes to COVID and being made redundant. But generally, I think you would be able to find another job. The real risk for you is if you were to get sick. Okay, a few more minutes left. Let's talk a little bit about Kiwisaver. So for those under 35, 40, I would have no expectations that New Zealand Super will be around. I would think it would be much more like a benefit. So if that's going to happen, potentially, don't want to scare you too much, but you should be aware, then Kiwisaver is a really good option to have a nest egg in retirement. But the question becomes, there's so many different providers. Which ones are the good ones? You know, they all do advertising, they all sound great, but which one should I pick? Which fund should I be in? Should I be in a low-risk fund? Should I be in a high-risk fund? What do these different assets mean? So our final poll question of the day, Kirsty, is asking all of you, have you made an active choice about your Kiwisaver? And by an active choice, I mean that you've picked a provider, you've picked the right fund from low risk to high risk, and you've picked a level of contributions. That's interesting. About 2/3 of you seem pretty happy, pretty confident with the decision that you've made. So when we think about what funds we should be in, generally speaking, if you've got a longer time until retirement, you might take more of a growth profile. If you've got a shorter time in retirement, until retirement, you might be in a moderate or a conservative fund. But it doesn't really work like that either, because we had 40,000 Kiwis during COVID where the markets went and then jumped back up. That move from high risk to low risk. So it's not just based off your stage of life, it's also based off how much your Kiwisaver can drop before you feel uncomfortable. It's important to make an informed decision though. What I think is more important though than which provider you pick, you should make an active choice around your provider, but what's much more important is being in the right fund, low, medium, high, and your contribution levels. Let me give you some scenarios. Say you're 40 years old, you earn $90,000 a year, and your Kiwisaver balance is $40,000. If you work until 65, and you're in a low-risk fund, contribute 3%, you might have $270,000 by age 65, $389 if you're in a low-risk fund with 6% contributions, a balanced fund, $360,000 at 3%, 6% contributions in the balanced fund is $509, high risk 3%, $488, 6%, $677, and the holy grail high risk 10% contributions is $930,000. Now, firstly, these aren't inflation adjusted, so important to keep that in mind. But this isn't to say that everybody should be in a high-risk fund with 10% contributions. There's no point being in a high-risk fund if you can't stomach the volatility. You'll end up in a worse situation. And in addition to that, you might want to use your contributions to pay down your mortgage or invest into a business. You might want to do something with that additional capital. What I'm trying to do in this scenario, though, is to help you understand that the fund that you're in and the contribution levels do make a big difference. So it's just important you make an active choice, and you're also realistic about how much volatility you can stomach, how much of the ups and downs you're comfortable with. We've got some more questions here around an off-topic question. Regarding Kiwisaver and the first home grant, if I previously worked part-time and contributed less than $1,042 the year into Kiwisaver, did that year count? Probably best to talk about that one-on-one, Dan, but I don't think so. Any other questions about Kiwisaver? I just bought my first home last month and I'm still in a this is an excellent question. So they've just bought their first home, they're in a conservative fund. Should I move to growth now, even with uncertain markets? You should never choose a fund because of where the markets are at the moment. If you are 30, you are going to have 4 or 5 GFC COVID type events that will happen to you. You just need to pick a fund that you're comfortable with the drops. So for example, in a growth fund, you're going to end up with the best returns long term, but your money could go backwards like 25% in 12 months. You need to be able to hold. So if you've got a long time frame, generally you can take more risk, but it's really important you're comfortable with those drops. Okay, I'm very conscious of the time. I never run over. So a few key takeaways is you may be closer to buying a house than you think. Talk to a broker, talk to the bank, sign up to the next workshop. Good debts are okay. Those bad debts with high interest rate, you've got to come up with a plan to pay those off. Small increases on your mortgage can make a big difference. From a budgeting perspective, give every dollar you earn a job. Make sure that you're a conscious spender, not a mindless one. Hopefully we've got more than 7% that are interested in insurance now. Make sure you're being responsible. Yes, you could spend that money on something else. Yes, we hope insurance is a waste of money. But if you don't have it, just remember, people never expect to get sick or to die, but you've got people that you're responsible for, even if that's yourself, and make an active choice about your Kiwisaver. One more plug to stage 2 and stage 3. So I'm seeing some good comments in here saying people have loved today's workshop. That's awesome. This is just the surface. Like, this is very high level stuff. In stage 2, which has got no cost to you, it's just another 1 hour workshop. You can sign up to your stage of life, which is relevant to where you're at, and we're going to really get into the weeds. I'm going to give you some reflection time, some notes to take so you can move towards your financial goals. And then stage 3, you're going to have the chance to have a free one-on-one consultation with a financial advisor where you can get all your cards out on the table and you can have somebody that's going to help set your roadmap up for success, which is, I mean, I'm excited about it. Hopefully you're excited about it as well. So I'm very conscious it's 3 o'clock now. It's been amazing how many questions have been asked throughout this, but I would be more than happy to keep asking the questions, but we probably need to wrap up there, Kirsty.
James, thank you so much. That has been amazing. I'm really sorry. Thank you. Thank you for muting. Happy to go over for another 5 minutes if you're happy to. For those people that do need to dash off, though, don't worry. We are recording it, and we'll send you a link to that recording in due course. And as James mentioned, we have got the other workshops, retirement planning, first-time buyers, and mid-career, already on our website. If you would like to register, it has got limited spaces, so we would recommend registering as soon as you can. And they are interactive workshops as well, so please bear that in mind. But yeah, James, if you're happy to crack on for another 5 minutes, more than happy to carry on recording.
Yeah, I'm more than happy to go on for a bit of a rant for 5 minutes. For those that need to run off, please feel free to do so. I love we've got a question here about how do you become a financial planner. If you run through the rest of these sessions, you'll get my personal contact details. I'm more than happy to have a Zoom or a coffee and talk to you about it if you're thinking about moving away from the engineering space. Somebody's asked, can you do stage 3 without stage 2? If you just want to jump straight to stage 3, I'm sure we could work that out, but considering we've got limited spots, it would be really great to see you invest that hour of time to get ahead and to plan, so you can make the most out of all of it. Got another question in here. For a 20-year-old, which of the 3 sessions coming up would most apply? It'll be the first one. It'll be the one around first home buyers. First home buyers, I don't want to call it people early in their career, because that's not true around some people might be later in their career and buying their first home. But in that, I'm not just going to talk about first home buyers. I'm going to talk about Kiwisaver a lot more. I'm going to talk about budgeting a lot more. So I'd say that. Got a question here around, if I'm self-employed and just contribute the minimum 1,042, is there any reason I should put more into Kiwisaver? No, as long as you're... So let's take a step back. For those that don't know, if you contribute up to $1,000 a year to your Kiwisaver, you'll get $520 from the government for free. It's free money, happy days into your Kiwisaver. The question is, if you are self-employed, is there any benefit in contributing more than the minimum? No, there's not, except for the fact that Kiwisaver is a cheap, generally good managed fund. So you might just put the money in there to continue to see your Kiwisaver grow. The only catch to that is obviously it's locked in. So you could invest that money into an unlocked Kiwisaver/managed fund. Another one is, we aren't up to the topic yet, or we got past it now, but with Kiwisaver, how much can your account/partner's account contribute, and what are the benefits for putting Kiwisaver percentages to the max of 10%? So you can actually make like extra payments into your Kiwisaver if you want to. The benefit of putting in more than the minimum of 3% is to help plan for your retirement and help build it up, or potentially help build up for your first home deposit. The only catch with that is you might be better off to have that money available to spend on paying down your mortgage or saving for your first home or something like that. somebody said, can we attend multiple stage 2 sessions? Yes, you can, Jen. The only catch is I do duplicate a little bit with the content because some things are relevant to multiple groups. So for example, one thing I talk about with all of those groups in stage 2 is around setting goals and setting a financial plan so you know where you're going. Can you use your Kiwisaver as part of a house deposit? Absolutely. You just need to be in it for a minimum of 3 years. So you can't access your Kiwisaver before then. But say if your Kiwisaver is $20,000, you could take out all of that $20,000 except for the $1,000 kickstart. So I'm seeing a lot of people where their Kiwisaver is a bigger part of their deposit than their savings account. In the retirement session, will you just be talking from a view of Kiwis staying in New Zealand or also migrants who aren't sure? I'm trying to work out how not to screw over my future self with bits of money scattered around a complicated tax situation. I'd say a one-on-one session would be the best option for that because that's probably a bit too specific. I just bought my first house last month. Congratulations. And I'm still in the conservative fund. Oh, so I've already answered this question. I might just touch on that again though. And Kirsty, feel free to tell me when to stop talking because as you know, I'll probably keep going. One thing to think about is if you're in that first home buyers group and you plan on buying a property in the next few years, if you're in a growth Kiwisaver, you should probably rethink that. The reason for that is you're planning to use that money in the short term. So maybe a conservative fund might be a better Kiwisaver for you to be in. The reason for that is during COVID, when the markets dropped, some people were ready to buy their first home and their Kiwisaver had dropped, which meant they didn't have enough money to buy their first home. So if you've got a short-term goal like buying a house, you might not want to take as much risk in your Kiwisaver.
James, I was just going to say maybe another couple of questions, but there is one there about, I don't understand, you've got to be in it for 3 years comment regarding Kiwisaver.
Yeah. So the way Kiwisaver is designed is the question is, do I need to be in Kiwisaver for 3 years to be able to use it for my deposit for my first home? The way the Kiwisaver legislation has been written up is you have to be in it for a minimum of 3 years before you can take the money out. So for example, say if you've been in Kiwisaver for 2 years, you can't use it. You either have to choose to buy a house without Kiwisaver, or you've got to wait another 12 months until you hit the 3-year mark. That's just how the Kiwisaver rules have been designed. And I'm going to pick one random one because I missed so many because, I mean, it was just great how many questions we had. Somebody's asked around here is, before I spoke about there'll be 1 out of 10 situations where you can't save with your budget. That's for people that are going through a really hard time. So they might have multiple people that are dependent on them. They might be, really good example at the moment is you might be on 60% of your pay. You might be unemployed at the moment because of COVID. You're not going to be able to save in those scenarios. But if you're just in normal life, you don't really have too many people dependent on you, or you've got a good income, there's a way you can make your money work to be able to save more. And that's simply by going line by line through your expenses. And I know when you go through online banking and you look at the credit card, you look at the check account, you go, jeepers, I spent that much last week. I have those moments. Everybody has those moments. You just got to make sure you don't have them too frequently. But I will keep going through these questions unless I stop myself. So Kirsty, I think we'll call it there. Thank you everybody for how many questions we've had. It's just been great. Over 100 people on the call. Please sign up for stage 2. I'd love to see you all there where we really get into the detail.
Thank you so much, James. And I'm sure everybody really found that helpful. I certainly did. I'm going to be looking at insurance now. You'll be pleased to know. So yes, thank you again to everybody that's dialed in. I'm just looking at the figures of people that are actually registering for those next lot of workshops. So my suggestion is please register sooner than later because there are limited numbers. So thank you again, James. Any questions that anybody has, please feel free to email branches@engineeringnz.org. We will send you the recording in due course, and a survey will be sent out tomorrow with those links for the registration of workshops. But as I said, I would probably suggest try and get on there sooner than later to register. Thank you again. And just to exit, please click on the cross on the top right-hand corner. Thank you.
Have a great day, everybody. Bye.